Hello and welcome. In this video, we will discuss earnings reports and how to read them. Publicly traded companies publish quarterly 10Q and annual 10K operating results. These are at times supplemented with press releases and sometimes with earnings conference calls with company executives. Publicly traded companies publish their operating results quarterly via 10Q reports they file with the Securities and Exchange Commission, that's the SEC. Company executives are honest, but they do present their earnings in the most favorable light. Executives try to avoid surprising investors and market analysts with unexpected negative earnings news. They guide analysts' expectations through official forecasts, news releases, and telephone calls. This is a highly regulated arena, so management takes great care to share information to all investors equally and within other regulatory guidelines. Companies strive to report bad news well ahead of earnings announcements and to avoid a dramatic negative response in the marketplace. Thus, they provide guidance information to analysts and other investors to suppress expectations and to soften the impact of coming earnings news. Large publicly traded companies really try to adjust expectations so they are able to deliver earnings that are at or slightly above analyst expectations. They strive to avoid surprises, either up or down. They want to maintain an orderly marketplace in their stock price. There are also actions company management can take to adjust their earnings to align with analysts' expectations. They can shift when certain expenses hit their income statement, perhaps moving something to the next quarter, or adjust the timing of revenue with aggressive sales promotions to accelerate or delay shipments and the resulting profits. These are all acceptable practices within limits, but occasionally management group crosses the line into illegality through clearly deceptive accounting practices. That is when we read of it in the newspapers, and a company executives do get prosecuted. Remember Enron? Executives in their accounting firm were prosecuted for blatantly illegal and deceptive accounting practices. Enron and its accounting firm are no longer in business, and Enron and its companies, like it, are clearly exceptions. Most companies operate legally and ethically. Companies do try to avoid earnings surprises because they can impact their share prices. Often the impact is short-lived. You should watch for surprises, but do not overreact. Most of the time, these short-term blips in price due to surprise are not indicators of the company's long-term health. Look at the situation closely and make your own judgment. Remember, an earnings surprise may be due to inept analysts' forecasting. We mentioned earlier that earnings guidance is highly regulated. Some companies avoid this practice just to steer clear of any chance of being accused of inappropriate behavior. The practice of speaking about the future is called forward-looking statements. Since these statements discuss or hint at the company's future sales and earnings expectations, they can be troublesome if the events the company anticipates do not materialize as they expect. In such a case, analysts or shareholders may feel they were purposefully misdirected. For that reason, many companies have concluded to avoid this practice. Forward-looking statements were, in the old days, called whisper numbers. In those days, the whisper number was selectively released to a few analysts, essentially to give them advance notice. That is now illegal. So-called fair disclosure regulations now mandate that companies broadly announce any future-related news to all investors simultaneously, so all have a level playing field. Even today, you may hear of some sort of whisper number going around. It may not have come from the company, but you may see it on a financial blog or other places. And if it is out there, it can create expectations and stock price volatility, even though the company may have had absolutely nothing to do with floating that whisper number. Let's talk about this some more. You now understand that a company's earnings release is compared with expectations and that it can, and often does, impact the stock price, at least in the short term. Why? You may have heard that statement, "Oh, that news is already in the stock price." That phrase expresses the reality as future-related news becomes known. It gets reflected in the company's stock price. A company's stock price typically does reflect all information that is known and expected to impact that company's operations and performance. The stock market does not like surprises. If it expects the company to grow 15% and it only grows 10%, that can be interpreted as disappointing news, and the price can fall in spite of the favorable achievement of 10% growth. Some investors see this as a temporary aberration. Others see it differently and alter their view of future prospects for that stock. Therefore, most analysts make a concerted effort to accurately predict a company's earnings. This is a great incentive for the analyst and for the brokerage firm to be accurate. They do not like surprises. Who does? All parties desire an orderly and predictable marketplace. Volatility is an unwelcome disruption to the market. There is even a market for predictions. Companies exist whose business is preparing and selling forecasts to professional investors and institutional managers. These professional predictors gather up as many predictions as possible, compile them, and publish their assessment on what the consensus of other analysts are saying. They report the highest and lowest estimates along with their consensus estimate to follow and provide a feel for the range of other estimates. We see this sort of practice during national elections for presidency. There's a variety of polls. There are firms that compile all the polls and publish their consensus estimate of what the polls are saying. There are often large differences among the polls, or in the stock market case, earnings estimates. This sort of disparity indicates uncertainty, and you should interpret that with less confidence than you would a more cohesive set of estimates. Certain stocks are followed by more analysts than others. The big companies have lots of brokerage house analysts following them. The smaller companies, however, receive less attention and have fewer analysts following them. This results in fewer estimates and less certainty about any consensus estimates. That makes your job as an investor more burdensome because of the greater chance of unexpected surprises. This creates a fertile environment for that whisper number. Consensus estimates are broadly available for the large companies, but smaller companies are more susceptible to the impact of whisper estimates. And remember, these can be coming from all sorts of sources, some perhaps with professional analysts, but many also coming from pundits, other shareholders, people with an agenda, etc. These whisper estimates are, by definition, less reliable. It's best to remain cautious and skeptical. Due to aggressive SEC regulators, the fear of insider trading charges have greatly dampened the chance of a whisper estimate that's coming from Wall Street insiders. It's more likely these unofficial estimates are now emanating from the other investors, not professionals. You now need to be cautious about consensus estimates. Are they from professional analysts, or from shareholders, or other biased pundits? It's your hard-earned money and your investment decision. Just keep all of this in mind and read the estimates. If you're able to determine that the source is other investors, consider that source. Be alert to the possibility that this estimate, or even a consensus, may be from investors or pundits that have a vested interest in promoting or demoting a company's stock price. You should be especially cautious in the penny stock arena. Due to the low stock price, these stocks are especially vulnerable to news and to special interest group influences. Earlier, we mentioned the impact of earnings versus expectations is usually short-term and not indicative of a company's long-term prospects. Thus, if you are a long-term investor that intends to hold the stock for long-term gains, you should be reluctant to act on whisper estimates and less prone to react to price variations that appear to be solely the result of a quarterly earnings number varying from street expectations. If you're in for the long term, you know it will go up and down due to the variety of factors. You're only interested in the company's overall trend and any factors that could alter your assessment of the company's long-term prognosis. Whisper and other estimates are much more important to you, and if you are an active investor whose investing strategy is to actively trade the ups and downs, that is because differences between the actual and expectation earnings can have a profound impact on short-term stock price movements. If you're in the active trading mode, you may want to act on whisper estimates just so potential discrepancies don't whipsaw you. Remember, whisper estimates may be about all you have on smaller companies that have limited analyst coverage. In those cases, you may decide to act on those unofficial estimates since that's all you have. But understand, they may be a consensus of other shareholders' viewpoints, and so may be vulnerable to the influences we've just discussed. Nonetheless, if you're a short-term trader, you may consider them another investment tool. A word of caution that bears repeating: insider trading laws are serious business. Remember what happened to Martha Stewart. Be cautious. You don't want to make investment decisions from what you hear a company's employees or friends of employees. This is playing with fire. Do not act if you happen to come into possession of what is probably non-public information. You'll have to incur legal defense expenses, and if found guilty, you'll have to give back any ill-gotten gains, plus a hefty fine, and possibly jail time. That's not worth the risk. Today's guidance, which is in the form of company-issued forward-looking statements, is a valuable investment tool. Statements that are coming from the company are from the people that know the company best, the inside managers, so that is worthy of your attention. Include this information with analyst forecasts and the consensus forecasts. Make your own value judgment on how well they align. A good analyst that closely follows a given stock is valuable. They thoroughly digest any guidance, news, and evaluate management decisions in light of their stated corporate goals and strategies, and they're well positioned to assess management's expectations. They have their own independent viewpoint on whether management is being overly conservative or optimistic in their expectations. Analysts use a company's guidance statements to anchor their own estimates and improve their accuracy. There is no denying that the market is highly focused on short-term results. So is company management. It comes down to incentives. Investment managers and company managers are all incented to exceed last year and exceed expectations. Their pay packages provide bonuses for outperforming past performances and current expectations. Overperformance creates a growing stock price, and this is the goal for all parties, including the shareholder. Given this emphasis on short-term performance, analysts are incented to be as accurate as possible. They especially value any sort of guidance from the company to facilitate their forecasting. This guidance also helps you in your own analysis of expectations and management decisions. Companies engage in guidance activities to avoid volatility in the stock price because they realize just how fixated on the market is on short-term performance. It is unfortunate that this fixation drives dramatic volatility, which is a disservice to all parties. As stated earlier, most companies are honest and are obligated to disclose all the news, good and bad, in their quarterly earnings reports. However, they do engage in techniques to manage the market's response to that news. They and their publicity companies use these techniques to soften the blow of the news that may impact their operations or earnings, including softening the impact of positive news that might overinflate their stock price. Their goal is to have their stock trading in an environment of orderliness and predictability, if possible. These techniques are in the way information is presented. For example, words like challenging, pressured, slipping, and stressed are often used to soften the blow of certain news. For example, the company's news release might say prices for profit margins are under pressure. They might use phrasing like this rather than the real story of saying competition is forcing them to hold prices in an environment of rising costs. Negative news may be buried in the text or near the end of the release to minimize its impact. They will lead off with positive news about future plans and prospects, but supplement news that may depress earnings. These and other techniques distract the reader and soften the impact of less than favorable news about the future. Once you start watching for these techniques, you may notice how the release is structured with certain information in bold or italicized typeface to focus your attention on selected upbeat news. The astute reader will recognize these little tricks and realize what's happening. They'll thoroughly read the release, read between the lines to understand the implication of what is not being directly stated. To better understand what management is really saying about the company and its future performance, sometimes overt actions require thoughtful consideration to fully understand the implications to the investor. One example is stock buyback programs. There are, on the face, positive news for investors. Few shares outstanding will increase the earnings per share, which will improve the price earnings, which is the P/E ratio, and usually increase stock price. Ask yourself, why are they doing this? Why now? Many times such programs or other positive news is announced at about the time negative news is released as well. Is this just coincidence, or are they attempting to distract attention away from the bad news? Be an astute reader. Uncover the real story, what it all means for your investment decision. This is the real bottom line for how to read and understand earnings reports. It is understanding the importance of expectations, the importance of how they are created and managed, reading the releases with care and thoughtfulness, and being equally informed about a company's competitors so you have a thorough view of the industry in which the company competes. We hope you found this video helpful and have expanded your understanding of financial analysis. You too can invest knowledgeably. These videos are designed to help you build your investing knowledge and skills. Develop and understand your investment goals, your plan, and then choose your investments carefully and prudently in keeping with your plan and with the knowledge you gain from these videos. Thanks once again. We wish you all the luck in the world.